PIMCO's been investing in commodity markets since 2000. We're one of the longest tenured asset managers in the commodity space. We manage over $20 billion in assets ranging from mutual funds to ETFs to private strategies. We have expertise in broad baskets of commodities. Our investment strategies are not only confined to traditional index-based commodities, but we look at assets across the globe and across every type.
Single real asset allocations typically start for investors with gold, as it's been a store of value for a millennia, and we don't see that to change in the future. However, two of the pitfalls with allocating to a single commodity or single real asset instrument is the lack of diversification, and second, the inflation hedging potential. Gold prices are typically linked to the level of prevailing yields in the market, and during an inflation spike, central banks are typically hiking interest rates, thus bringing down the return potential for gold and hindering its inflation hedging properties. Another single instrument real asset allocation choice that investors look at are natural resource equities. Those allocations typically inherit a high equity beta, which is linked to growth rather than inflation, thus bringing down inflation hedging properties similar to gold. We marry fundamental research with quantitative techniques to come up with commodity-specific return expectations and then allocate proportionally such that we maximize our return expectations per unit of volatility for our client, while maintaining the two most important aspects of a commodity allocation: inflation hedging and diversification.
If you look at the last 5 years, not only has commodities been one of the better performing asset classes, most importantly, they were a liquid, real asset that provided genuine diversification. Many of the themes that drove the returns over the last few years, we think, are consistently going to present a positive tailwind to returns over the next 3 to 5 years, such as capital investment in traditional hydrocarbon is underperforming what we believe is needed to meet future demand growth. 2, we have new sources of demand that we have not had in the past. Specifically, investing in the energy transition is very carbon intensive. Second, AI and data center demand is a new source of commodity demand, both for metals and energy, which is likely to transform the power sector demand. These are tailwinds that we think present real opportunities for investors to look to capture.